Hi, everybody. It's Steve Gorin. Welcome to this TCLE, Pass-Through Entities Held by Trust, Formula Transfers and Estate Planning, and Business Gifts when selling a business. So you should have the slides from your resource widget, and then also you should also have a download of my newsletter, which has the different articles that support this particular webinar. So before we begin, I want to cover some other housekeeping items. If you have any questions during the webcast, you could submit them through the Q&A widget at the bottom of your screen. We will try to answer you during the webcast, but if a fuller answer is needed or I run out of time, then I'll answer it later by email. You can also find the materials besides on our resource widget. You can find them on our website, and encourage you to download any resources or links you found useful. You can find additional answers to some common technical issues located in the Help widget in the bottom of your screen. This webinar is CLE accredited in California, Illinois, and Texas for 1.5 general credit, and in Missouri for 1.8 general credit. We will award CLE based on attendance for the entire 90 minutes. From time to time, you'll be required to click a pop-up screen to reflect your continued engagement. The certification icon located at the bottom of the screen will tell you if you've met our criteria for awarding CLE. It does not include the certificate of attendance. To verify your attendance, your certificate will be emailed to you later this afternoon. This webinar is being recorded and will be available within 24 hours. You can access it from our website, www.thompsoncobra.com. All in attendance will also receive a link to the recording. Opinions and appreciate your participation in the course. Okay, so let's now go through the slides. And before I get into it, just mention about, we have a lot of potential changes coming up with the next election, and I want to remind everybody what the overriding principle of tax reform is, which was coined by Senator Russell Long, who chaired the Senate Finance Committee back about 40, 50 years ago. So his guiding principle of tax reform is don't tax you, don't tax me, tax the man behind the tree. So I think that's what you're going to have to look for going forward with our changes in the law, and we really don't know what's going to happen after the election either. All right. So slide 2, overview. I'm going to talk about consequences of trust owning interest in S corporations and partnerships, which is going to be an overview of my materials. It's going to be more like how you can use my materials as a good resource. I'll have some substance in there too, but I really want to kind of guide you through it because a lot of people find it intimidating to go through 2,500 pages and even with the table of contents. And I want you to know what's there and some good issue spotting. So that's going to be the first segment. The second segment will be on formula transfers. And we have 2 cases in 2020 that inform when you make formula transfers. And of course, a formula transfer is when you are wanting to transfer an interest in something that's hard to value, and you would like to try to protect the client against IRS audit results being bad because you just don't know what the value is. And no matter, even if you get an appraisal, you don't really know what the value is. What it says it, what they agree what it is. And then the third segment will be on business gifts and alternatives. And so this is the idea when you're selling a business and the employer would like to give some money to the employees, kind of cut them in on some of the success from the sale. What's the best way to do that? And we have some very clear statutory law, but we also have a lot of case law. And there's a 2020 case that informs some of the issues there that I'll also mention. Okay, so that's the overview. And by the way, everything that I'm saying here, I'm doing this as a kind of a condensed thing for each of these segments, but I will have longer programs that will be qualified for CLE and CPE credit. And you'll see at the very end of the slide a link to those. So I know we're doing just kind of the highlights here, and for those who want more in depth, they'll look at the last slide, and you can go and spend some more studying. Okay, so we're on slide 3 now. So trusts owning interest in pass-through entities. So the way that my materials work is, you can see, by the way, that there's a parenthetical here, like you see that Roman numeral 3A3. So that's the reference that's in my 2,500 pages of materials that covers that particular area. So my trust holding stock in S-corps basically goes through the various nuances of that. Not only who can hold stock and when the elections need to be made, but also the income tax consequences of it, and some very important planning issues. And I do have some more slides that go into that in more detail. So I also have another provision that talks about Code Section 678 trusts. So those are trusts where the beneficiary is a deemed owner of the trust. And we talk there about what it takes to make the trust be a deemed owned beneficiary. And there's a lot of people who are trying to do a lot of fancy planning, and a lot of times they overlook some of the details on whether the trust is a wholly owned grantor trust for all purposes or just for some purposes. So the some purposes may be reporting the annual income versus all purposes being for sale purposes. I've got some materials on the Code Section 199A deduction, and I'm not really going to talk about that, focus on that here. That's the 20% deduction for qualified business income. It came in with the 2017 tax reform. I saw a summary of Biden's tax plan, and I figured that they would just, raise the corporate rates and then get rid of this deduction here, because this deduction, the purpose of this deduction for qualified business income is to try to put people in pass-through entities kind of on a level playing field with people who have C corporations, because C corporations had such a radically significant tax cut. And what summary I saw said that Biden was going to increase the corporate rate from 21% to 28%, but he wasn't going to do away with this deduction. And instead, he was going to phase it out and say that you get the deduction at the lower levels, but at the higher levels, you don't get it. So I thought that might just be going away if the Democrats get in power and they just want to repeal like everything that happened in 2017, but apparently not. Apparently he's interested in keeping this. So my materials go through extensive coverage of that, and it includes the legislative history, the code, the preamble to the proposed regulations, the preamble to the final regulations, and the final regulations. So all of that is in those materials. And just in this past quarter, we did get final regulations on some aspects of the qualified business income. Those mainly were dealing with how you treat losses and carrying forward losses for purposes of the qualified business income deduction. There were also some things that dealt with the separate share rule and share remainder trust. I don't think those are really all that significant, and they follow what the proposed regs did. But nevertheless, you do have complete coverage there. NAA stuff is pretty much up to date. So, and there's the net investment income tax, and we're going to go through some of that as well on the trust selling a business. I'm going to go through some more slides that go through these details a little bit more. So trust holding stock and S corporation, had a qualified risk and protective measures. And one of the big issues there is just think about how we make a trust be a wholly owned grantor trust. So we don't want it to be something that changes beneficial interest, because then the grantor can have the ability to change that, or otherwise they'd be risking quote section 2036 inclusion. So what we do for that is you will then consider what ways to do it. The way that most people use is a swap power, a power to substitute assets of equivalent value. And a lot of people rely solely on that. Sometimes I'll add the power to borrow as well. But the bottom line is, if you look at the regulations on this, it says that that whether it qualifies for grantor trust treatment or not depends on the facts. And I'm not really all that comfortable with that in terms of if I wanted to give somebody 100% guarantee on that. If the IRS were to find that the trust were only 99.9% owned, then the IRS could say that it's not a qualified shareholder. Now, as a practical matter, the IRS isn't going to be doing that. But what happens is when you are selling your company to a strategic buyer, they have their tax advisors scrub everything really thoroughly, and they look for any risk whatsoever. And if they find any risk whatsoever relating to the S election, then they can give you a hard time about trying to get the deal closed. And so then you may need to get a private letter ruling, and private letter rulings can take like 6 months or so. And I'm not sure what the time framework is now with the pandemic, but 6 months is typically what the IRS will quote you on the phone. Sometimes you get them to rush things through, but if you have a strategic buyer in the wings and you're waiting for 6 months for a private letter ruling, imagine that strategic something happening and you lose that strategic buyer during the time you're waiting for the private letter ruling. So that could be a real disaster. So as a safety measure, I make an electing small business trust ESBT election. And my materials go into that some more. But I've pretty much regularly been doing this. Whenever I have an irrevocable grantor trust that holds stock in S corporation, I will do the ESBT election. Okay, next slide. I kind of mentioned all of these resources before, the first two bullet points. The third bullet point was interesting. There was a private letter ruling, or there was more than one, and they had a qualified revocable trust that elected to be taxed as an estate, and then there's then once the 645 election terminates, so then you need to do something about your S election. Here was they made the election, and then they transferred the stock to trust. And another part of this rule says that when you transfer stock to a testamentary trust, or you made your election to treat the trust, your revocable trust, as an estate, so it's deemed transferred from an estate, the downstream trust, the trusts that are created when the revocable trust terminates, those downstream trusts have up to 2 years to make a QSST or ESBT election. And for those who don't know what the QSST or ESBT election is, I don't have time right here to go over that because this is more of an overview here, but the materials go into that in detail. But you have to make one of those elections, and in this case, they hadn't made the QSST or ESBT elections in time after the 2 years from having transferred it to the downstream trust, and so they got some inadvertent termination relief. I don't think that's really all that significant, but just want to point out that people just didn't pay attention to these deadlines. Now, for me, if you go to slide 6, I kind of even take the opposite approach of what these guys did. They waited to the last minute and even beyond. For me, I get concerned about the income taxation. So if you have an S corporation and it distributes less cash than the K1 income, then you have some tax issues. It's very common. Like if you have somebody who had $1 million of income, they might distribute only $400,000 just so that their shareholders can pay the taxes, and they might reinvest the rest of $600,000 in the business. Well, if you do that, then how much can you distribute to the beneficiaries? Well, if you distribute the whole $400,000 to the beneficiaries, then the trust still has $600,000 left and has to pay tax on it and has to pay the taxes. So ultimately what would happen is, in that example, you're going to keep the whole $400,000 inside the trust to pay the taxes on the $1 million, and you're going to get everything taxed at the highest bracket. So contrast that with if you had a qualified subchapter S trust or QSST, and with that, the beneficiary is the deemed owner of all the K1 items from regular operations. And in that case, if there's $1 million K1 and a $400,000 distribution, the beneficiary gets that $400,000 distribution and has to pay the tax on the full $1 million. Trust doesn't have to pay any taxes. But the beneficiary, when the beneficiary gets that $1 million K1, they have the full run-up in the brackets. So whatever lower tax brackets they have to be fully used, and so you're not going to have everything taxed at the highest bracket. So I like the idea of quickly funding any downstream QSSTs so we can get all the income tax at their lower personal rates. So contrary to the idea of putting it off to the last minute to make your election, I like to, as quickly as is advisable under the situation, and then make the QSST election and get that income tax at low rates as soon as we can. Now, that's not always the smartest thing to do, and my materials kind of go into the pros and cons of it. Okay, slide 7, QSST and ESBTs. So you can see there I have a whole variety of issues that we go through, and I'm not going to go into them now. I just want to let you know that's there, and it's a good idea to think about it. I mentioned the QSST is a trustee owned by the beneficiary. Some people may be tempted to create an S corporation and a QSST just to get the favorable income taxation, but there are some disadvantages to that. And again, just go through the materials and take a look at those. Slide 8, Code Section 678, beneficiary deemed owned trust. So I kind of go through how to make it apply, and it's particularly that portion rule that applies when the withdrawal right doesn't apply to the trust. So if you have a withdrawal right over $1 million and the trust grows to $1.2 million, and then your $1 million withdrawal right lapses, then you only have the grantor trust as to 10/12 of the trust. And so you do have some significant issues. So the materials go through that. They go through asset protection issues. There's a 2020 private letter ruling, which was obtained by Jonathan Raccoon, an AgTech fellow, a very smart guy. And basically in that case, the beneficiary has the right to withdraw all the assets except for an LLC that the trust owned. But then when the LLC would get sold, they had the right to the sale proceeds. So what happened is the trust sold the LLC to another trust that was deemed owned by that beneficiary, and the letter ruling said that there was that was a grantor trust as to the sale, because the sale proceeds belonged to the beneficiary, and the buyer trust was deemed owned by the beneficiary. So I think that's a pretty unusual situation, but it is the most recent development in that area. Okay, Code Section 1998 deduction, I already discussed that. Slide 10, the net investment income tax. So for those of you who haven't heard me talk about the net investment income tax before, I like to remind you of the movie Monty Python and the Holy Grail. And if you abbreviate net investment income, you'd abbreviate it NII. So for those who know Monty Python and the Holy Grail, you would know how to pronounce that, which is neat. And back over 40 years ago, they knew that neat would be a bad word. So this 3.8% net investment income tax applies to business income, and I have a lot of materials that go through that. I've really spent a lot of time focusing on it. Passive income generally is going to be subject to the 3.8% tax. We talk about rental income, which is generally per se passive. When you sell your partnership or S corp, talk about whether the gain, how much of that gain is subject to the net investment income tax and how much is not, and various strategies to consider to minimize the 3.8% tax. Fiduciary income tax plays into the 3.8% tax because whatever the trust distributes out, you would potentially tax that at the beneficiary's level, and so you look to see whether the beneficiary is subject to net investment income tax. Whereas whatever the trust retains, you would then apply those rules to that. So you see I have some resources there that kind of talk about this correlation of the fiduciary income tax rules with the net investment income tax. Slide 12, passive loss rules. I have pretty extensive coverage of the passive loss rules in my materials. Again, that was one of the things when the 1986 Act passed and I practiced accounting, I paid a lot of attention to them. And then I went to practice law. The timing of taking the losses or not, that was just something for the accountants to figure out. And as a lawyer, I didn't really have to pay as much attention to it. But now I do, because there's a current tax. It's not just the timing of taking the loss, it's the 3.8% tax. So in 2013, when the net investment income tax regs came in, I did a lot to pass the loss rules. And whether a trust is actively or significantly participating or purely passive, I have a lot of materials on that. For the net investment income tax, the issue is not material participation as much as it is something else called significant participation. So in terms of making the income be non-passive, the passive loss rules basically have kind of a heads I win, tails you lose approach to the passive loss rules if you view them in isolation. When they got passed in 1986, we didn't have a net investment income tax. So what they wanted to do is say, okay, it's going to be hard to deduct a passive loss, but we really don't want the income to be characterized as passive income, because then you could offset passive losses against it. So what they said is you have to work for more than 500 hours in order to make a loss be non-passive. But if you work more than 100 hours, then we will recharacterize your passive income as being non-passive income, because we don't want to have a passive income generator. So that's called significant participation activity, when you participate for more than 100 hours. So my materials spend a lot of time going through participation by a trust, and what it takes to get there. There's a lot of there's a lot of kind of common knowledge there, which might not actually be correct in terms of what's out there. And I encourage people to look at the materials to have a more full discussion over some of those issues. Another interesting issue is that depreciation expenses actually can pass through directly to the beneficiary. So when the trust gets a K-1 from a partnership, for example, when you have a non-grantor trust that owns a partnership, then generally the partnership needs to separately state what the depreciation deduction is, because a trust doesn't reserve for depreciation will generally be passing through the depreciation deductions directly to the beneficiaries. The depreciation deductions, in fact, don't even appear on the trust income tax return if the trust is distributing all the income to the entities. So what you do is the trust will simply, on its K-1 to the beneficiary, say, okay, here's a separately stated deduction. This is the only place in our tax law where a trust can pass out a loss before the trust terminates. Pretty unusual rules there. And then the question is, suppose the trustee is not may or may not be participating, but the beneficiary does participate in the business, then can the beneficiary deduct that depreciation? And my answer to that is yes, I think so. But the materials go into that. Trust selling a business, go through there all. So we're on slide 13. So we go through all those, a lot of different the issues that go there. One thing with the QSST, generally that's going to be a mandatory income trust. It doesn't have to be mandatory income if you pay all the income out, but most people will just make it be a mandatory income, at least while it holds the S stock. It's mandatory income. And then when you go to sell the business, the income from the sale of the business actually winds up being a trust item. It's not treated as owned by the beneficiary. In fact, if you're selling the business and there's a deemed sale of assets, and the whole thing is a deemed sale and liquidation of the business from the seller's viewpoint, then what happens is that the K-1 income that's attributable to the sale of the business assets is actually supposed to be staying in at the trust level. It doesn't get passed through automatically to the beneficiary, but you might want to pass it through to the beneficiary anyway. And you could do that either by making a distribution, an actual distribution, or after the fact, you could say, hey, is there a way that we can recharacterize the gain on the sale as fiduciary accounting income, and then that way it's a mandatory income trust. You can go ahead and get the deduction for distributing that gain from the sale out to the beneficiary. Well, harken back to the discussion before about, suppose you had $1 million K1 and a $400,000 distribution. Well, $600,000 of that income is being reinvested. So from the beneficiary's viewpoint, it might be only fair to give the beneficiary the benefit of some of that reinvested income. So when you're going through after the fact, and you might want to be pushing some of the gain from the sale out to the beneficiary, if that's a desirable thing to do, then just go and make what we call an equitable adjustment. And that's basically saying that all this income was reinvested, but the beneficiary paid tax on it, so it's only fair to distribute some of that income to the beneficiary. And so you can recharacterize some of the gain on sale of those assets potentially as distributions that were required to be made to the beneficiary, and then have that flow out to the beneficiary. Okay, let's go on. Slide 14, some net investment income tax issues, the materials go over that, so I'm not going to spend time on that. So that completes the coverage of that particular topic. So I'm going to go on to define value clauses. So we're on slide 15, and we're going to talk about why to use them and kind of do a brief comparison to GRAT. We'll talk about a formula that describes how much is transferred with provisions for where any excess goes. We'll talk about using a disclaimer. We'll talk about using a formula that describes a purchase price, and we'll talk about achieving finality. And again, there are two 2020 cases that dealt with some of this some of these formulas, and so I'll do a reference to those too. So slide 16, why to use it? So if you have property that's sold to an irrevocable grantor trust, and that's a difficult to value asset, then, valuation, even though we try to be objective with it, there's a lot of judgment calls that go into it, and the IRS can have a different judgment call than our appraiser can have. And now there are some taxpayers who want to try to game the system to the nth degree, but for most of my clients, it's just a matter of, hey, I want to do a sale. I don't care what the sale price is. I just want to do the sale so I can get the asset into the trust, and then we'll deal with paying down the note. A sale to an irrevocable grantor trust, it's going to get the note's going to get repaid through tax distributions, over the, it's often over 5 or 6 years, but I usually make my notes 9 years just in case. But it's going to get paid off. That note's going to get paid off regardless of the number. If it's a closely held business that's just it's not marketable, doesn't have access to the stock exchange or that type of thing. So clients just want to sell it for whatever the number is for the fair market value, and if the value is higher than they thought, then maybe it's an extra year or two to pay off the note. But there's really no consequences to that otherwise, in terms of they don't really care what the value is. Now, at least that's what I try to discuss with clients and make sure they understand that, and that the irrevocable grantor trust will work as long as you give it enough time and come to us in advance long before you die. So we're just trying to eliminate uncertainty in tax results. We want to sell it for whatever the fair market value is. We don't care what that is. So what we want to do is we want to sell it for the finally determined gift tax purpose and gift tax value. We're going to get into that language in a little bit. So slide 17. Now, a lot of people tout GRAT because that does away with all of the valuation issue on the initial gift to the GRAT. But to me, that's only part of the game. there are consequences to administering the GRAT and determination of the GRAT. You need to consider. So one of the things is that if you have a foot fault and maybe you don't distribute your GRAT payment on time, maybe you have maybe you make a distribution. So suppose you're paying your annuity in kind. All right. So I try to avoid that. What I'll do is, if you're gonna do a GRAT for a business, maybe you do it like over 7 or 8 years, and then I'll have the first few years of payments will be all in cash. And when we do what's called a graduated GRAT, each year you can increase the payment by 20%. So you start off with a really low payment, and the payments get higher as the GRAT goes along. So the first few years are relatively low payments, and you can pay that often with the GRAT income, and then you can make cash payments. So that's what I prefer to do. Suppose somebody did a 2-year GRAT for their business, and now if they're going to sell their business in the next few months, and they do the 2-year GRAT, then that's a great safety valve. But let's suppose the business doesn't sell, and you don't have the cash to make the annuity payment, and then you have to pay with distributing some of the business back out to the grantor. So when you do that, you are giving an asset with an uncertain value in exchange for this annuity payment of a dollar amount. So what position might the IRS take for something like that? Well, let's suppose the annuity were going to be $1 million. If the IRS says, well, that property that you gave back to the grantor is really worth only $800,000 because you yourself said there's lots of valuation discounts, and we think there's more than what you said. So now there's $200,000 shortfall in your distribution. So you didn't administer the GRAT correctly because you didn't make the whole payment when you were supposed to. Or they could say, well, that property you distributed was worth $1.2 million, but you're only supposed to get $1 million. So you've given $200,000 extra. So you've really kind of prepaid the GRAT obligation. And the regulations require you not to prepay the GRAT obligation. So you've busted your GRAT. So those are ideas that the IRS might make. I mean, I think that there's more worry about it than there's actual cases. But, I worry. I mean, you're worried about valuation anyway. That's why you did the GRAT. But so aren't you going to be worried about whether the annuity payment was correct or not? So that is a concern with that. There's also an idea you can't turn off the grantor trust powers for a GRAT because the power to get the retained right to get the annuity payment back is a grantor trust feature. And I think about 15 years ago there was a case somewhere in St. Louis where they had what I call an exploding GRAT. They put some S corp stock into the GRAT, and the S corporation was so successful that the K1 income was huge, and the grantor went bankrupt because the grantor couldn't afford to pay the taxes on that. Now, there are ways to deal with that. You could have an income tax reimbursement provision built into the GRAT, potentially, but you need a plan for it. But again, you can't turn off the grantor powers. There's extra planning that you have to do. Whereas the sale to irrevocable grantor trust, generally you structure it where you can turn off the grantor trust powers. Now, one advantage over a GRAT over a sale to an irrevocable grantor trust is if you die during the GRAT term, then you can get a state tax deferral under Code Section 6166, which you would not be able to get if you just have the note in your estate. On the other hand, if you die during the GRAT term, then you might have the whole grant including your estate, whereas if you die with the sale to irrevocable grantor trust, then you might just have the note including your estate. Finally, when the grant terminates, you can't allocate GST exemption to fix your inclusion ratio for a grant up front. With a sale to an irrevocable grantor trust, let's suppose you had, you wanted to have a $10 million deal. Maybe you do $1 million gift to the trust, and you sell for a $9 million note. And if you have an irrevocable grantor trust, you just declare a $1 million gift, allocate GST exemption, and you're done. On the GRAT, at the end of the GRAT term, if that's worth $10 million, you need to have $10 million of GST exemption to be able to protect that from GST tax down the road. So then your GRAT is going to stop between whatever your GST exemption that's left that you can allocate versus the part that isn't. And then you have a part that's not protected from GST tax, and then you have to figure out, well, how do you do that? Well, maybe you're going to sell from the non-exempt trust to the exempt trust. There's some other issues with that too, which I'll discuss a little bit later. Okay, so on the next slide, let's move on past GRATs. So you can tell I'm not that great a fan of GRATs for closed-sale businesses. I like them for marketable securities, but not as much for closed-sale businesses. But again, we all have our preferences. I can't say there's a right or wrong. All right, so on slide 18. So one way to do a formula is to say I'm transferring, for example, $1 million worth of LLC interest. And it's going to be based on whatever $1 million value is as finally determined for gift tax purposes. And so there's a case called Wandry where they did something kind of along those lines, and the IRS attacked it, and the tax court said, "Hey, that's fine. Taxpayers, they did their transfer, they did their appraisers to try to make a good faith effort toward it. We're going to respect their clause there." Now, the IRS did non-acquiesce on that case. They said, we think it's wrong. And they explained why they thought it was wrong. But they didn't appeal it. So they didn't put their money where their mouth is. Some people think because there's a 10th Circuit case, the King case, which I really like, that didn't. It wasn't Wandry case. It wasn't Wandry clause, but it did provide sympathy for formula valuation. So people thought that the IRS was concerned that the 10th Circuit's precedent would be something that would appeal the one that would uphold the Wandry case, and that would make it a more powerful thing than just being a tax court memorandum. But the IRS is on record; they disagree with Wandry. There's also something in my materials there about an article that was written by Austin Bramwell and some other folks that questioned about whether a tax case can really determine what was transferred. So you could read the article and decide whether you agree with Austin and his colleagues or not. Okay, so going on to slide 19, required language. Required language needs to say something along the lines of, as finally determined for federal gift tax purposes. I'm going to spend some more time on that later on in this webinar about how the language I tend to kind of use when I couch things. But there's a case in 2020, the Nelson case, where the person said, okay, I'm going to transfer, X dollars worth, or maybe it was a sell X dollars worth and I'm going to do a business interest equal in value to that determined by an appraiser. And the appraiser determined a certain amount. And then the IRS came in and said, nope, it's a higher amount. And the taxpayer said, well, I said it would be the appraised value, whatever that is. And the tax court said, you said it would be the appraised value, whatever it is, as determined by that appraiser. You didn't say that's finally determined for federal gift tax purposes. So you didn't use the magic language, so you don't get the benefit of using the magic language. You got to say it. We are not going to read the magic language in there. You have to actually say it. So they said, your appraiser determined the quantity of what you transferred. The IRS came in and proved to us it was a higher value than that, so you're stuck with that. Okay, let's go on to 20. So again, we're in the formula that describes how much is transferred. So if you say, I'm giving away, there's a couple ways to do it, but suppose you say, I'm going to do a transfer of $5 million worth of stock to this irrevocable grantor trust for my child. And you say, if the IRS determines that the value is worth more, then I'm going to give the excess to charity. So if the transfer were for only $5 million, then the charity really is getting nothing up front, and only if IRS audits it. And I'm going to talk about that in a moment on the next slide. But you can have this excess. It can go to charity. It can go to a spouse outright or to a marital deduction trust. If you do a marital deduction trust, I recommend a general power of appointment marital deduction trust instead of a Q-tip, generally. But there are circumstances when I do a Q-tip as well. But I'm just saying there's some more complexities if you do a Q-tip. So I'll leave you to the materials to look at that. You have a gift over to a GRAT or an incomplete gift trust. Those have not been litigated at all. So they theoretically should work. But just wanted to give you that caution. Okay, now if you have the gift over to the charity, make sure it's a meaningful gift, whether or not the IRS audits. In the Moore case on the slide 21, it was kind of what I described to you before. The gift was something that was intended to be $5 million, and it said any excess over $5 million goes to charity. So the charity only gets if the IRS audits. So charity doesn't really have much incentive to get involved. What's the charity going to do to even try to obtain an interest? Are they going to go and call the IRS and say, please audit my potential donor? I don't think so. So the tax court really didn't like what went on with that. It'd be better to have a meaningful gift over so that the charity has some incentive to audit. The charity itself has an incentive to kind of negotiate with the client what the gift is. Not necessarily with the client. We'll talk about that in a moment too. But a record that demonstrates due diligence by the charity will make the gift more likely to be respected. So give them something significant. Okay, slide 22. In the Grave case, the charitable deduction was denied because there was a gift to charity that it might have to give back. And when you are going to get charitable deduction, you need the charity to be pretty certain that it's getting that gift. And In that case, there's a chance the charity would have to give the gift back, and that gift was that the chance of that happening was not negligible. So there was a significant chance that the charity would have to give some back, and so that ruined the deduction. Christensen case was a formula disclaimer that resulted in a charitable gift. So if daughter disclaims, then anything she disclaims goes over to charity. So daughter can say, hey, I disclaim any excess over X dollars worth of gift. And so that way she can use this time-honored idea of a disclaimer, which courts respect disclaimers, regulations respect disclaimers, and if you do a disclaimer, then it's really not going to be argued successfully by the IRS. I say that if you do have a choice to do a disclaimer versus a formula gift, I'd rather do a formula disclaimer than do a formula gift in terms of wanting to have certainty on being able to win with the IRS. But a disclaimer might not be appropriate because it depends on where the money goes and what's the consequence of doing that disclaimer. There's a Petter case, approved a transfer to charity and a sale gift transfer. And again, that was based on values that finally determined for gift tax purposes. So the courts respected that. So on slide 23, this was one of the first charitable cases with a formula, the McCord case. And what happened is the deal was that X dollars goes to the family and the balance goes to charity. And after the transfer, the family, the donees, and the charity obtained appraisals and figured out among themselves who got what portion of the business interest. The donor was not involved in that process in any way whatsoever. So the donor basically says, here's the deal, you get X dollars worth, you get Y dollars worth, it's up to you guys to figure out how to divide it up. So there was nothing abusive from the donor, from the viewpoint of the donor being able to play games, because the donor wasn't even involved in how they divided it up. So McCord was a very interesting way to do it, and in the appropriate case, that might be a way to consider. So slide 24, I already mentioned about formula disclaimers having long been recognized. If you're doing a transfer to the trust, then the question is, are you having the beneficiary disclaim or the trustee disclaim? If you have beneficiaries disclaim, you need to spell out in the trust what happens in the event of a disclaimer. So you might say if the primary beneficiary disclaims, then the trust doesn't even get to keep it, and it goes to charity. If you build that in, then fine. But if you don't build that in, then you have everybody disclaim, including people who are not even living yet. So that might be really tough. If you do transfer to the trust and you want the trustee to be the one doing the disclaimer because you don't want to have to get everybody to sign off, and then you should expressly authorize the trustee to disclaim. So I just want to make sure that I'm clear, because the second bullet point, looking at it now, is a little bit ambiguous. If you transfer to the trust, there's two different ways to do it. One is the beneficiaries disclaim. The other is the trustee disclaims. If you are going to do it with the trustee disclaimer, then you should expressly authorize the trustee to disclaim, because the law out there is not necessarily clear as to whether just a trustee has the power to disclaim. And just think about the idea, the trustee has the duty to protect the beneficiary's interest. If the trustee is disclaiming, then they're moving money away from the beneficiaries. So it's kind of dicey to get the trustee to disclaim. So it's definitely possible, and it's definitely something that I've seen done before, and it's worked okay before, but there are a few issues you have to think about. So the next issue is adequate disclosure on gift tax returns. So all the stuff that we were talking about is finally determined for gift tax purposes. The only way it can ever get finally determined is if you file a gift tax return. So when I do a formula transfer, I also require the person who is the donor for gift tax purposes, they sign off on that agreement that they personally agree to file a gift tax return. So that way we can get the statute running so we can figure out what is finally determined. If you have a sale to an incomplete gift trust, there's some arguments as to whether the filing a gift tax return reporting a sale to the incomplete gift trust will actually work to run the statute. And that's in the materials. I'm not going to go through all the details right now, but I just want to let you know about that. I mean, I tend to make sure that there's going to be some substantial part of anything that would be not a completed, not an incomplete. So I might put like 10% of it is going to be a completed gift. So I go through that in the materials there too. Sale from one trust to another. How do you run the statute of limitations? You would need to get all the beneficiaries of the first trust to, and of the second trust potentially, because there can be gifts back and forth depending on the sale price, get all of them to file gift tax returns. And if there's an incomplete gift trust, then you have those arguments I just mentioned concerned about. Also, the GST statute of limitations isn't going to run until after the later of the transferor dying or making a distribution to a beneficiary, a skip person. So that's pretty dicey too. So sale from one trust to another is kind of a challenging thing potentially to get finality on it. Defined consideration clause, by that I mean a purchase price. This is my favorite way to do it. And not everybody agrees with me, and I think it's a judgment call. But I like it the best because we know how much is transferred. And those other things with the gift over, like if you did a gift over to a spouse or to an incomplete gift trust, then the IRS audits, so then you have something that's left that you still have to do estate planning with because it's in the spouse's estate or in your estate as an incomplete gift trust. So then after the audit, you need to go back and do even more. If you do a transfer that I'm transferring all of this and I'm going to pay the purchase price, whatever the value is, I'm paying it. And if the IRS adjusts it higher, I'm just going to get more back. So that's the philosophy that I tend to prefer. So here's how you do it. Slide 26. You sell the property for the formula purchase price with a blank in the face amount of the promissory note. You obtain an appraisal, and you have an allonge to the note. That's called like an allonge is like an amendment or kind of a supplemental document, and that provides the estimated purchase price. So I'm selling this for the amount is finally determined for gift tax purposes. My appraiser has estimated the value is $1 million, so I am estimating that my note is $1 million. So the appraisal did not determine the $1 million note principal, rather it estimated it. The determination is when it becomes audited or the statute of limitations runs. Then it becomes finally determined, and then you can wrap everything up and do whatever adjustments are needed to reflect the correct price. So we never say the value is X. If IRS adjusts on audit, then we change to Y. That would lose to Proctor. So instead, the value is finally determined. We estimate that it's X. And if I determined it on audit as Y, well, it always was Y because because it's the finally determined amount. So anyway, that's why this is my favorite thing to do on slide 28. I just kind of mentioned what I already said. So that wraps up that portion. So now the next part is business gifts and alternatives. So again, the main idea for this is when you sell your business, you like to cut in the employees. How do you do it? And there's other circumstances too that might not necessarily be the sale of a business. So first, let's start off on slide 29 as to when a gift to a service provider is compensation and not a gift. So first, I'm going to talk about a transfer from an employer compared to to the employee. So the company pays the employee versus a transfer from an owner to the employee. So you have a corporation. If the corporation makes a transfer to the employee versus a shareholder makes a transfer to the employee. We're going to talk about that. And then we'll talk about a 2020 tax court case where there was an alleged gift from a business associate and how the tax court came out with that. You can probably already tell by the way I phrased that how it came out. So we'll talk about those. When is a gift compensation and not a gift? And then we'll talk about whether you just recognize up front that it's compensation and how does that strategy compare to trying to take the position that it's a gift. Okay, so on to slide 30. So just starting off from some general fundamentals, when you have a business gift, you can deduct only up to $25 for that business gift. So it's not going to really benefit an employer much to do a business gift in terms of you give something up and you're not getting a deduction for it. So the Tax Reform Act of 1986 said that the income tax exclusion does not apply to any amount transferred by or for an employer to or for the benefit of the employee. So the employer gives a holiday bonus at the end of the year and gives cash out. That is compensation, and that's not going to be a gift. Another example might be the employer pays premiums on policy on an employee is owned by a life insurance trust that the employee set up for the employee's family. So that's not, the employee doesn't personally get that premium. The irrevocable life insurance trust does. But nevertheless, that's deemed to be a transfer from the employer to the employee, and then from the employee to the life insurance trust. So again, the income tax exclusion does not count as income tax exclusion for gifts do not count if the employer is paying the employee, with a couple of exceptions I have mentioned on the slide. And the employer is required to report this on Form W-2. Now, in this case, it was whether the transfer was a gift from the employer. So we know that normally a transfer from an employer to employee is not going to be a gift. So that's clear law according to Internal Revenue Code Section 102, parentheses C. Now, what about a transfer from a business owner to an employee of the corporation or partnership? So in that case, it's not a transfer directly from the employer to the employee, but it might be a contribution to capital of the business, followed by compensation from the employer to the employee. So you need to kind of test it. Is this truly a gift from the owner to the employee, or is it a deemed contribution to capital? And slide 32, so we have a regulation right on point for a corporation. It says that we will do this deemed contribution and compensation arrangement if the payment is in consideration of services performed for the corporation. So, example, so you have the person who owns 100% of the stock of the corporation, and there's a key employee, and they want to give the key employee some skin in the game. So the owner says, all right, key employee, I'm giving you 10% of my shares in the corporation. So under that regulation, that is going to be considered to be a contribution to capital of those 10,000 shares, followed by compensation, of that 10% of the shares, followed by compensation from the corporation to the employee of that 10%. Now, what you would wind up doing is you would wind up grossing up the employee, and this grossing up concept we're going to go through in more detail toward the end. Okay, but what if instead this were a gift for some reason? So where do you look for this? There's a case called Duberstein, a 1960 Supreme Court case, and I've got all this in the materials there. But I gave you a quote here, slide 33. So it says, again, some of the standards that just because you don't have legal or moral obligations, it doesn't mean that it's a gift. And if the payments do come from a constraining force or moral or legal duty or some other incentive, then it's not a gift. Got some more quotations from it on slide 34 that if the payment is for services rendered, it's irrelevant whether the donor derives economic benefit from it or not. So you can see all the language there: detached and disinterested generosity, out of affection, respect, admiration, charity-like impulses. Those are widely bandied about. You'll see those all over the place in this area. And we looked to see what the transferor's intention was. So, what was the intention for the payment? But what the proof is, look on slide 35. Slide 35. You don't just look to see what the donor says. You do an inquiry as to whether it's really a gift or not. So you got to look at the objective facts, not just what he says, she says. Slide 36. 1983 case where the majority shareholder gave some of their sale proceeds to key employees and gave lesser amounts to retired employees. And the minority shareholders did not participate in this. So what was the characterization? On slide 37, the majority shareholders felt that they owed it to these key employees to give them some money when they sold the business. But the tax court said that the key employees didn't expect to get anything from the sale. And so we're not going to count, even though the majority employers kind of felt that they had some moral obligation. In fact, there was really no expectation, moral, legal, by the donees as to ever getting this money. So, and again, it says here, it's a good idea. It's nice when the shareholders do that, but again, it's not a moral obligation or duty. And you don't want to say that they had a duty because that's just not the law. So slide 41. So the IRS argued, well, this was just deferred compensation. The employees were undercompensated, and so now they're paying them to make up for it. But as a matter of fact, there wasn't. So the compensation was fairly done in the past. So this is not disguised compensation. Slide 42 is some of the proof that they were not undercompensated. Slide 43. The fact that the majority owners made the gift while the minority owners did not shows that it was more of a gratuitous thing. If there were really some kind of a business reason, that business reason benefited both the majority and minority shareholders. But the majority shareholders never asked the minority owners to kick in anything. So the fact that minority owners didn't kick in helped with the argument that this was truly a gift by the majority shareholders. Now get this. In this case, these shareholders said to the recipients of their gifts, I'm giving you a gift. And then they turned around and deducted it on their income tax return. So then the court had to kind of talk about that. And they said that even though these guys tried to deduct this thing, that was an improper deduction. And you can see on slide 45 some more language from the case that, the fact that they deducted it means that they thought it was compensatory, not a gift. So these guys wanted to have their cake and eat it too. They wanted the IRS to help pay for their gift, but then they didn't want to have the employees tax on the gift. So they had inconsistent treatment, and they decided to whipsaw the government, and basically the court said, well, even though they tried to whipsaw the government, we're still not going to count this as compensation because the people who received it actually were donees. It was gratuitous. Another thing that was important is that the payors told the donees that they were gifts and didn't have to pay tax, and so that was kind of consistent with the objective evidence. So their subjective intent was not necessarily going to be sufficient, but it did corroborate the other evidence in that. So you can see the ultimate conclusion that this was gifts. Now let's go on to slide 48, our 2020 case. And again, in this case, there was payments made to a business colleague, and you'll see the amount soon enough. And the tax court looks at this and looks at Duberstein and says that the most important consideration is what the donor's intent is, and that the donor's characterization is not determinative. The court has to make an objective inquiry. So they were basically looking at the old cases and saying, yes, we got the donor intent, it was helpful, but it still needed to be corroborated. 549. They made the distinction between a common law gift, or a gift for gift tax purposes, or a gift for income tax purposes. And so you can see the difference here. Common law gift is that the donor did just any consideration back. Section 102 gift is more narrowly defined. So for income tax purposes, for the exclusion, that's a narrower test. It has to be detached and disinterested generosity. So from a gift tax purposes, we want to make it easy to find a gift so the IRS can tax it. That's the theory behind the taxing statute anyway. So for gift tax purposes, if you make a transfer and don't get anything back, that's a gift. We want to make it easy to tax them. On the other hand, we don't want to make the exclusion from income tax to be that easy. The donee needs to be able to prove this detached and disinterested generosity. And you can see here where a donee has rendered services to a donor. Payment for services is not a gift, even if there is no obligation to make the payment. So that's a really key idea there. And again, in those other cases, the services were rendered to the corporation, not to the donor. Slide 50. So, look at the amount involved. Almost $25 million. Ultimate issue is whether the taxpayer persuaded the court the transfer totaling almost $25 million constituted gifts from the payor. And the donee has to prove it. And if the donee does not prove it, then the argument that their gifts doesn't work, and there's going to be some income. So what was the intention of the person who made transfers? Well, in this particular Kroner case, the transferor was a non-resident alien. I think he was like from Britain or something like that. But I don't remember where he was from. But he was a non-resident alien, and there was a lot of big deals. And the taxpayer didn't want to drag the guy into court. So the court said, look, we would really like to know what his intent was. I mean, you have to have objective proof to back it up or not to back it up, but it would be really good to hear from him. We're not going to require you to produce him, but you still have to prove it. You have to prove his intention. So go on to slide 52. So what did the taxpayer said? They had a business relationship. It ended before the tax year, and you got to be buddies. According to the taxpayer said we were buddies, and so he gave almost $25 million to me. And look at what the tax court said. We do not find petitioners and the witnesses' testimony credible about this close personal relationship. You have not proven that there was anything more than a business relationship where occasionally personal matters were discussed. You know the drill. People like to get friendly with, people who provide services like to get friendly with people who receive the services. And, people like, first of all, you just like to get to know the people you're dealing with, on either side of it. But just because you get to know somebody and you're kind of friendly with them, doesn't mean you're willing to give them $25 million. That's the heart of the court's argument. So then the question was, how did the taxpayer try to prove the detached and disinterested generosity? And they didn't find any proof that that there was something that was, the relationship was that close, it would justify a $25 million gift. You know, I'd be happy to take the guy out for dinner if he's going to give me a $25 million gift. I don't know about you. So slide 54. It looks like what happened was the transferor, Mr. Herring, acted as a nominee for the taxpayer when they did some deals. So there were actually some legal impediments to the taxpayer participating in a particular transaction. And you know, when that sale of the business occurred, it was all owned by this Mr. Herring guy, and then Mr. Herring happened to give $25 million to the to the taxpayer, and the court just said, "Look, I don't buy it. It looks like there were some kind of dealings relating this business that got sold, and we're going to, find that that was not a gift." But the bottom line is that the taxpayer failed to meet the burden of proving that it was gifts. So something suspicious going on. We don't really know. We can't really find from that something really evil going on. But at the same time, the taxpayer has to prove the case. The taxpayer has not proven the case, and therefore the IRS wins. Now, on slide 55, we do taxpayer that the fact that you didn't get the guy to testify, that we were not going to hold that against you, but you didn't provide any corroborating evidence that it was a gift. And if you got him to testify, maybe he would have convinced us that there was a gift. None of the evidence you gave us proved that there was a gift. If you got him to testify, maybe we would have viewed the evidence differently, because maybe his testimony might have persuaded us that he intended there to be a gift, and might have let us kind of color the evaluation of the other evidence in a different way than we did. But you didn't. You didn't get him to testify, so we are not persuaded by, we're not going to color any evidence you gave us in your favor. We are, we have no clue what his intention was. You didn't prove it objectively. You didn't even get him to testify, so too bad. All right, so that's the standard. But you can see here that the donee has a burden of proving that it was a gift, and the donee should probably get the donor to testify. And they did have testimony in those other cases I mentioned, in one way or another, directly or indirectly. The testimony involving actually the donor himself or herself. So we've got a case here where there's some significant risk being taken because of the burden of proof that the service provider has to put on. Well, what if you just decide, hey, we're going to just own up to it as compensation? So think about it. The employer can deduct compensation paid, and then the employee would include in income the compensation that was paid. But maybe the benefit of the deduction to the employer can allow the employer to do what we call gross up the employee. So here's an example. Bottom of slide 56, assume a 40% tax rate and you want to get $100 an employee. Slide 57, if the employer could pay, suppose you want to get $100 cash to the employer actually pays $167 cash and includes $167 in income. But on $167 is paid, you take 40% of that, that's $67. So 167 cash is paid minus 67 withholding is $100 cash to the employee. So the employee still gets 100 cash. So you're declaring 167 in compensation and 67 withholding. Then the employer gets the deduction for that 167 and gets that same $67 tax savings. So effectively what happened is the employer gave $100 cash to the employee. The employer paid $67 with the withholding, but when the employer filed his tax return, it took a deduction and it got a $67 tax benefit for that deduction. So the employer was really not out of pocket anything more than $100. That's the theory behind this idea. Now, the idea kind of breaks down a little bit in that the employer and employee need to pay FICA tax on compensation. And also, what if the employee and employer are not in the same tax bracket? And one issue which I've seen happen before is that if the payment is very large, the deduction might very well push the employer into a lower tax bracket and the employee into a higher tax bracket. And that wouldn't be good at all. And here's where that really happens on slide 59. If the employer is taxed at capital gain rates are significantly lower than ordinary income. But if the bottom line is that the employer already has enough deductions to offset ordinary income, and then really all that's happening is the capital gain rate on the sale of the business. And then when they have a deduction for the compensation paid to the employee, that's an ordinary deduction, but all they have left is capital gain that they're offsetting with it. So even though it's an ordinary deduction, the only income that's being offset is capital gain, so their tax savings is at capital gain rates. So the deduction is worth less. So it's being deducted at capital gain rates while the employee is reporting ordinary income. So this kind of breaks down. Also note that there's payroll taxes on it, and so the payroll taxes increase the cost to everybody. So you may get some kind of an offset through the compensation. It's probably not going to be perfect, but consider the alternative. What if it's a gift instead of compensation? Well, if the donor has lots of exemption out the wazoo, then a gift is good. But if the donor is a taxable estate and you consider about a 40% tax savings, that may be out of pocket, that whole 40% estate tax cost. So you have the 40% estate tax cost without any offsetting deduction. Yeah, it's deferred many years in the future, but how does that 40% many years in the future compare to this offset that I just described with the income versus expense? In many cases, the compensation is still more worthwhile. So I kind of go through other ideas in the slide. I'm going to leave those to you to look at because I'm nearing the end of the time here. I don't really have any questions that I've received, but I've had some comments made. But let me just flip on over here. By the way, here's the comments I had was a comment about the timing of Biden, if Biden is elected, when the law might change, and also there are reasons why the IRS doesn't act with a court decision. So that point was made. You can think about it on your own. Everything that I said here, again, in this 1.5 hour brief overview, each segment is going to have an hour to an hour and a half with a free course on lecturing for CPA Academy, and you get not only CLE but also CPE credit. So for those of you who are accountants, or if you have any accountant people who you think would like to hear this, they can get some free CPE. So I encourage you to subscribe to my blog. I have my heckling reports that come out every January. And if you don't subscribe to my newsletter, I certainly encourage you to do so. So October 27th is going to be my webinar for my third quarter newsletter. And with that, I want to encourage you to go ahead and submit your evaluations. We really value your feedback, and they do help inform on topics that I might present in the future, or maybe even topics I might expand upon later on. So I encourage you to fill out your evaluations. Thank you very much for attending, and look forward to more contact with you through another webinar or through just personal contact with each person. So look forward to it, and that concludes our webinar. Thank you.